Thank you so much for giving time to ET Now. It's a pleasure talking to you as always. To begin with, I wanted to discuss about the macro situation. There's a complete change in sentiment. You've seen that inflation is coming down. A lot is improving on the macro front. We are seeing some amount of growth revival too. So do you think that the promise Acche Din are finally here, or it's some more time away?
No, I think we have to look at the promise as a promise of governance over a full term, right? I think expecting that you're going to come and wave a magic wand and things are going to change is an unrealistic expectation. Having said that, yes, the sentiment has improved a lot. Whether we look at global investors or domestic investors, clearly there is a belief that the right things will happen, and the government is focused on pro-growth, pro-development, pro-jobs policy framework, and that should encourage growth and investment. India always had the positive of a large market, but the stress was coming from the fact that people thought it was too difficult to do business. So I think the steps that we've taken towards that will help. The fact that the government really got its act together and did something on the coal ordinance very quickly after the Supreme Court judgment, I think that's another big positive. There seems to be serious effort towards getting GST going. So for a less than 6-month period to see all of this action, I think it's very confidence inducing. And therefore, even if we don't see the numbers in growth right now, I think growth will come. And in addition to the steps that the government has taken, I think we've also been lucky because oil prices have come off enormously, and that of course helps both our twin deficits, the fiscal deficit and the current account deficit. So it leaves us as a country in a better position to pursue growth. So I would say Acche Din look like they are coming.
Okay, and you mentioned that the government is doing its bit to revive growth, but which are the key sectors or areas you think need immediate attention so that this momentum doesn't get lost and it continues?
So for the last several years we've all been saying that the big issue in India is lack of infrastructure, and that goes across all kinds of infrastructure. Power, we still have short supply of power. Roads, airports have improved, but I'm sure we can do a lot more. Urban infrastructure, health, education. So there's just a lot of stuff to be done around infrastructure. But power and transportation becomes very, very critical, because without that, the manufacturing sector cannot grow. So fixing the power problem, I think, is a big priority. And then fixing GST is a priority as well, because it takes away some of the inefficiencies of goods moving across the country. So I think if we got those two fixed, then that's actually a big achievement.
And like you mentioned, that there are a number of things like fixing the GST as well as the power problem. But going ahead, you have seen that the government has at least started giving that push to the reform agenda.
Right.
But do you expect maybe the GST bill as well as the coal ordinance or any other reforms could get passed very soon? Maybe this year budget could have some of the very key decisions that Mr. Jaitley would go ahead and take?
I think we should separate the budget from the reform steps that we would like to see. Now, whether they come through in the budget session or some other session doesn't really matter, but these are all steps that are important to facilitate growth in the country, whether it's the power sector reforms or the GST or the ease of doing business steps being taken both by the center and the states. So we're seeing progress on all of that. And I think the budget is going to be watched eagerly by everybody, because this is the first budget where the government has had time to think through some of the objectives that it's going to pursue. So, are we going to stay on the path of fiscal prudence is something that people are probably going to look out for. Do we spend our money in the right places? So, is it being spent productively is another signal that people are going to look out for. So, we are hopeful that we will see that coming through in the budget.
And Mr. Jaitley is also mentioned,
and of course simplicity of taxation.
And in terms of GDP growth, where do you see us reaching, at least in FY15, and going forward, when do you expect us clocking in 7% or even above growth?
So I think this year, given that most of the year is over, it's probably safe to assume that growth will probably end somewhere around the 5% number, hopefully above 5%. And we would expect that with all the steps that the government is taking and with investors both domestic and international, feeling more confident that the capex cycle should begin to kick off sometime in the next year. I also think one of the things that doesn't get enough airtime but is important is that we are seeing projects change hands, and moving from maybe promoters who are more stressed to promoters who have the capacity to invest and grow. That means that even without a lot of new investment, we will see greater productivity out of existing capital. That will help growth as well. So I would believe that next year growth should begin to pick up, and for it to reach the 7% number, we probably have to wait for FY17.
And this brings me to RBI. They have given a dovish statement this time around saying if inflation continues to fall and fiscal prudence is measured, then they could also look at changing their stance even before the policy. We've already seen inflation is cooling off. WPI has just come in at 0%. So do you see the RBI could go ahead and cut rates even before the February policy? Could we expect that? When do you really see the interest rate cycle turning?
So as you said, we're seeing the macro, a lot of things change in the environment. So the fiscal is come under control, the current account is come under control, inflation is coming under control, helped of course by a lot of global factors, but also helped by steps that were taken domestically. So we're seeing all of that positive momentum. On the other hand, we are seeing growth struggling. So I think the growth inflation dynamic today is ready for a rate cut. Now, when RBI decides to do it, I guess will be dependent not just on what they've seen in the past, but what they think might happen going forwards. And so they probably want to see the base effect issues wash through, which, because we had galloping inflation last year around this time, the expectation is that January, the base effect issues could turn. So maybe RBI wants to wait till January, but nobody can second guess what RBI decides to do.
Okay, and as far as banks are concerned, you've been the first bank to cut its base rate. Deposit rates are on the downward spiral, everybody is cutting. But when do you see base rates in the system coming down? When do you see most banks doing it? Will they wait for RBI's cue? How much is the correlation between a policy rate cut and a bank cutting its base rate?
So, when we cut base rates, it was basically because our cost of borrowing came down for a variety of factors, primarily led by liquidity, but the dynamic of rate versus deposit growth. That's what kind of helped our cost of funding to come down, and that's what we passed on to customers through a base rate reduction. Subsequent to that, several of the banks and we also have reduced our term deposit costs by anywhere between quarter to 50 basis points depending upon tenure. Now, for this to wash through in terms of cost of borrowing will take some time, because it will depend upon when the old deposits mature and the new ones come and replace them. So that dynamic will take some time and pan out. And as that happens, and if this trend continues that there is sufficient liquidity and new deposits are cheaper than old deposits, then I think you will see that flow through into base rates going through in the future. The correlation between base rate and the policy rate, the repo rate impacts short-term cost of funding, and so it impacts a small portion of the total cost of funds of the bank. But it does also become a signal for the rest of the rate structure. So a repo rate by itself doesn't change everything, but a repo rate coupled with the right liquidity environment will flow through into reduced cost of borrowing for banks and subsequently a reduced base rate.
Okay, but could we see base rates coming down in the system at least in the first half of next year? Could we see that happening?
If the environment continues the way it is right now and we continue to see comfortable liquidity, then I think yes, you should expect base rates to come off. And if, as we talked, RBI does a rate cut, then I think that gives us more confidence that yes, base rates will begin to come off.
In terms of credit growth, we've seen that this year banks have struggled to meet at least the 15% credit growth target. Most banks have.
Yeah.
So when do you see the corporate credit demand really picking up? Some of the banks we speak to, they say another 12 months away before they can see corporate demand picking up.
So as far as corporate credit growth is concerned, there are a couple of factors impacting that. One is the fact that the investment cycle has slowed down, so therefore the need for capex requirements has come off. But even on the working capital front, the petroleum companies, their working capital requirement is reduced dramatically because of the fall in petrol prices. So that actually will correct itself over a period of time. And the broader working capital the demand for that will come back as growth comes back. So I think credit growth should begin to pick up. I don't think it's going to take 12 months. Our view is maybe in another couple of quarters.
And how much are you expecting Axis Bank per se credit growth?
See, Axis Bank is still just about less than 4% of the banking system. So we do have the ability to grow faster than the system. And we would expect that we'll continue to do that. Our growth on credit is going to be constrained more by what happens to growth on the funding side.
So in terms of asset quality, that's one issue that's been troubling the banking sector. So you had given a guidance that NPAs as well as restructured assets would be somewhere between 6,500 crores. Do you see that remaining in that band for the next 2 quarters, or there could be some pressure on that front? What's your outlook on asset quality?
So, when we gave the guidance for the year, we had factored in the belief that while recovery would happen, it would take time because, what I said earlier, you can't expect a magic wand and everything changes. And the causes of this pressure on asset quality have been, one, because some projects have got delayed or stalled, or we have a environment of low growth and high inflation, which is obviously a bad environment from an asset quality perspective. And we've also had a situation of payments getting stuck for various projects in different places, including for some of the projects which might have been executed for governments. So those 3 factors have actually caused asset quality stress to pick up. And we are beginning to see improvements in all 3, but it will take its time to flow through. And therefore we had given the guidance that we believe that addition to gross NPA plus new restructured assets could be up to 6,500 crores for the year as a whole. And yes, we are retaining the guidance for this year.
When could we see the turnaround in asset quality? Which quarter of next year do you really see that there will be a significant turnaround in asset quality pressures?
So, Simran, given that our book has a lot of corporate lending in it, and that tends to be a bit lumpy in terms of how NPAs and restructured assets could get generated, I don't think we can talk quarters. We've always said that please look at our numbers for the year, don't look at quarter by quarter, because it depends upon what happened to a particular asset during that quarter. So I think from next year you should begin to see an improvement in asset quality. So if this year's numbers are about 6,500 crores and our credit costs for this year end up at about 85 basis points, we would expect the absolute number for next year to be lower, and we would expect credit costs for next year to be lower as well.
Okay, and in terms of restructuring, RBI has given more flexibility when it comes to refinancing infra projects. That's one of the sectors that is most under stress. So how will this help banks? Do you see it as a big positive, especially keeping in mind the kind of infra exposure you may have at the moment? So what this flexibility that RBI has allowed, how will it help?
So I think, Simran, again, there's been a whole lot of commentary that I read around the announcement saying what was the objective and what is RBI trying to achieve. So let's get clear about what RBI is trying to do over here. RBI had recognized that when it comes to infrastructure and large projects, you need a different financing structure for it to be able to match the maturity of the project with the length of the loan, and therefore they came up with the 5/25 structure that is allowed for new projects but not for existing projects. So that's a kind of anomaly which existed in the system, and banks have been pointing this out to RBI that there's this anomaly which needs to be corrected, and therefore we should have the ability to, in the case of existing projects which are viable, also extend the same flexibility on the repayment schedule. So I think that's pretty much what RBI is trying to get done through the new set of norms, that flexibility should be given to existing projects as well. and they've put some stringent conditions over there, that they've said that your NPV can't be lower, and the entire repayment has to happen within 85% of the period of concession. So they're making sure that you still have 15% concession after this whole structure for it to play through. So I would think that it is a pragmatic policy which aims to do away with an anomaly which otherwise existed, and it's good for the system.
And in terms of the sectors, if you were to talk about which sectors are still under stress when it comes to asset quality pressures, and are there any sectors that are looking up?
So on stress, I think it's still some of the infrastructure sectors, some of the EPC contractors who may have got their payments stuck, and for some of the metals because of the drop in metal prices. So if I had to point out sectors, I think broadly those are the sectors which are still seeing some stress. In terms of where do we see opportunity, I think we are seeing some of the export sectors begin to do better. That's been happening for much of last year, and that continues. I think some of engineering selectively is doing better. But broadly, it's more companies rather than sectors that one needs to pick.
So in terms of your focus areas for growth, which would those be? You've been focusing on retail a lot, and in terms of your personal and card business, will that also take priority going forward? And how are you looking to boost your margins even further? Where could you see your margins ending at?
So strategically over the last 5 years, we have aimed to rebalance our book on the asset side. One, with a view to diversify the lending book, and two, to be able to offer a full suite of products to our retail customers. And that's why you've seen our retail lending grow much faster than corporate lending in the last 5 years. But I think today we have reached a higher level of maturity as far as that business is concerned. The book is a lot more balanced. Today retail lending is 40% of our book, so it's a fairly balanced book. We also have pretty much most of the products being offered to our retail customers, not all in all geographies, but most of the products are out there. So I think from here we would expect to see more balanced growth of the portfolio, though of course depending upon where opportunities arise, one segment could grow a bit faster than the other. But broadly I would think more balanced growth from here.
And how much growth are you seeing?
And as far as personal loans and credit cards are concerned, yes, we have seen growth in that. Again, within the suite of retail products, personal loans or credit cards are something that was launched a little more recently, so maybe 2 years ago rather than 5 years ago. So they may see growth momentum for a bit longer.
And in terms of your fundraising, we've seen on the debt side, you've raised over 5,000 crore infra bonds. You've also done about $500 million US dollar bonds. So wanted to understand any further issuances on the cards on the debt side. As far as markets are concerned, I think that's something that you'll still hold on to. So, and where do you expect to deploy all the funds that you've raised right now, especially on the US bonds? And going forward, any more fund issuances?
So, we haven't done a bond raising for more than a year. And so $500 million for a bank our size is not a huge fundraising in dollar terms, and it will get used to service our existing clients for their dollar needs. So that's pretty much part of ongoing business. Yes, I think we were good with the timing and therefore the pricing of that bond issuance, because it's probably been one of the finest priced bonds in a very long time. So we're happy with the way that bond raise went. We got a lot of interest from investors globally on the bond. As far as the infrastructure bond is concerned, it's I think the largest issuance under the new regime which RBI has put in on infrastructure bonds. And since we do have a fairly significant infrastructure book, we had the ability to leverage that book to do an infrastructure bond. And we raised about 5,700 crores from a variety of investors. So what we are happy about there is that the pricing was decent. It's a 10-year bond at 8.85, but we've got investors from multiple categories. So insurance companies, mutual funds, foreign investors, retail investors, provident funds. So So I think it's been a good issuance.
But any further issuances on the cards?
Nothing more this financial year, but of course we will plan fundraising for next year.
In terms of consolidation, that's become the most interesting topic in the banking sector. Kotak has taken the plunge and gone and acquired ING Vysya, and they are just little smaller than your bank now. So just wanted to understand about consolidation in the private sector. What are your views on that? And also, would you be looking at inorganic expansion going ahead?
So I think the Kotak ING transaction is a very interesting transaction. It's a great transaction for Kotak. I think makes a lot of sense. But for us, does it make sense? Not really, because we have 2,500 branches. We are in terms of balance sheet size, we are close to 400,000 crores. So in terms of size of both branches, deposit base and lending, we are quite happy with the scale and size we have, and we believe that we can achieve a lot of our growth ambitions organically. Having said that, if there was an acquisition opportunity which made sense for us from a shareholder value creation point of view, we would definitely look at it. Or if there was a big strategic gap that needed to be filled, then we have in the past done the Inam acquisition and integrated it well. And even though it took time for the benefits to flow through, I think it looks like a good acquisition in the context of the capital markets and the investment cycle returning. So we are not hesitant to do an acquisition, but it needs to make sense for us either from a strategic benefit perspective or from a shareholder valuation creation perspective.
So as you mentioned, you're still open to the ideas. So there are reports that Axis Bank wants to expand South India base. So they are in talks maybe with Karur Vysya or the likes of South Indian Bank. So just wanted to ask you, is there anything going on that front? Are you looking to expand South using the inorganic route? If it's a rumor, if you could put it to rest.
So on this particular one, I am not aware of any conversation happening on acquisition at this point of time in Axis Bank. We would look at opportunity, as I said, if it was value accretive to shareholders, but we are actually able to meet much of our growth aspiration organically. So for us, an acquisition may not have the same meaning that it would have for a smaller bank who is looking to aggregate a branch network. Okay.
In terms of ADR listing, a lot of your peers have done it and they've had a good experience. Wanted to understand from you, will you be interested in going for an ADR listing? Do you think now is the time, or maybe the next 1 or 2 years is something that you could look at an ADR listing for Axis Bank?
So it's something that we have looked at and evaluated a couple of times, and fundamentally it's a question of, does an ADR listing give us access to a newer, deeper class of investors? If so, I think we would look at it. We have to weigh that against the additional regulatory and reporting burden of being listed in another market. So we will keep evaluating the pros and cons of doing that and see what's the best path.
But is there a time frame, maybe next 2 years? Or?
There is no time frame. I think we would, as I said, evaluate what is the best way to access the US markets, and even today we have a lot of US investors who are invested in the stock. So we really have to see whether we get an additional benefit out of a ADR listing.
And lastly, before we finish the interview, I just wanted to understand passage of the insurance bill. How will it really boost the insurance sector? Will it change the game for the insurance sector? And you are mostly following the bank assurance model in insurance right now. But going ahead, would you like to have your own insurance arm, maybe even look at a foreign partner once this insurance bill passage happens?
Simran, I think we are very happy to look at all the opportunities that India provides in terms of growth to the banking sector, and I think there are enough opportunities for us to pursue in banking itself. So we are really not looking at this point of time diversifying into insurance. So we have a good banking business, and investment banking business, and asset management business. We are happy to grow those. So that's as far as Axis is concerned. I think we would continue with the distribution model and see how best to serve the interest of our customers and our shareholders through the model that we pursue. As far as the sector is concerned, yes, I think it's a good thing that the insurance bill comes through, because it's been something that's been pending for such a long time that it's a great signal to give to the markets to get it over and done with. For the insurance sector per se, it will create a situation of more capital for some of the companies which may have been needing that capital, and that coupled with other measures that the government could take to stimulate long-term savings, not just in the insurance but the pensions, the bond, the mutual fund sector as well, in terms of growing long-term savings. I think that should definitely benefit all of these sectors.
All right. Thank you so much, ma'am. Thank you for speaking to me. It was a pleasure.
Thank you.